Welcome back to our channel where we delve into the world of finance and technology. Today, we're exploring the intriguing comparison and contrast between cryptocurrency and traditional assets. We're not financial advisors, so consider this video purely informational. We aim to provide an insight into these two realms and their risk factors. As always, it's important to do your own research before making any financial decisions. So buckle up as we embark on this journey of discovery. Before we dive into the comparisons, we need to understand what we are comparing. So, let's start by defining what cryptocurrency and traditional assets are. Cryptocurrency in its most basic form is a digital or virtual form of currency that uses cryptography for security. It operates independently of a central bank and is built on a technology called blockchain, which is a decentralized ledger recording all transactions. Some of the most known cryptocurrencies today include Bitcoin, Ethereum, and Litecoin, among others. What sets cryptocurrency apart is its decentralized nature, meaning it's not controlled by any government or organization. On the other hand, traditional assets refer to the tangible and intangible items individuals or companies own that have value. These can include physical properties like real estate and commodities such as gold and oil, and financial assets like stocks and bonds. Traditional assets are typically regulated by financial institutions and governments, providing a sense of security and stability. The key characteristics of cryptocurrency are its decentralization, potential for high returns, and digital nature. Traditional assets, meanwhile, are recognized for their stability, tangible value, and regulation. Understanding these distinctions is crucial because it sets the stage for how we view the risk factors associated with each. Cryptocurrency and traditional assets operate in vastly different landscapes, and thus, their risks and rewards vary significantly. Now that we have a basic understanding, we can start comparing. The first point of comparison is stability and volatility. Now, when we talk about cryptocurrencies, one of the first things that may come to mind is their notorious volatility. The value of cryptocurrencies like Bitcoin can swing wildly in a matter of hours. This volatility is primarily due to the speculative nature of the cryptocurrency market. Many investors are attracted to cryptocurrencies because of the potential for high returns. But this means that the market can be driven by hype and emotion rather than by fundamental economic factors. On the other hand, traditional assets such as stocks, bonds, and real estate tend to be much more stable. While these assets can and do fluctuate in value, these changes are typically more gradual and predictable. This stability is grounded in the tangible, real-world assets they represent. Stocks, for example, represent ownership in a company and its future earnings, while real estate represents a physical property. These assets have intrinsic value that helps to mitigate volatility. Moreover, traditional assets are regulated by governmental bodies, which helps to maintain their stability. These regulations provide a certain level of protection for investors, something that is currently lacking in the largely unregulated world of cryptocurrencies. However, this is not to say that traditional assets are without risk. Economic downturns, changes in interest rates, and other macroeconomic factors can impact the value of these assets. But these risks are generally well understood and can be managed with a well-diversified portfolio. On the flip side, the volatility of cryptocurrencies can be a double-edged sword. While it can lead to substantial losses, it can also lead to significant gains. This potential for high returns is one of the reasons why some investors are drawn to cryptocurrencies despite their volatility. So, when comparing the volatility of cryptocurrencies with the stability of traditional assets, it's essential to consider your risk tolerance and investment goals. If you're comfortable with taking on more risk for the potential of higher returns, cryptocurrencies may be a suitable choice. But if you prefer a more steady and predictable investment, traditional assets might be the way to go. As you can see, there's a stark contrast in the volatility and stability of these asset classes. Next, we delve into the accessibility of these asset types. In the world of finance, accessibility refers to how easily an individual can get involved and invest in an asset. Traditional assets like stocks, bonds, or real estate have been the go-to for people looking to grow their wealth for decades, if not centuries. However, they often come with a set of barriers that may limit accessibility for some. For instance, investing in real estate generally requires a hefty amount of capital upfront. Similarly, investing in stocks and bonds often involves navigating through complex financial systems and regulations, requiring a certain level of knowledge and expertise. Not forgetting that these investments often need a significant minimum investment, which can be a barrier for many. Now let's contrast this with cryptocurrency. One of the most appealing aspects of cryptocurrency is its accessibility. Anyone, anywhere in the world, with an internet connection and a digital wallet, can buy, sell, or trade cryptocurrencies. It doesn't matter if you're in New York City, Lagos, or a small town in the middle of nowhere. If you're connected, you're in. Moreover, the technology that underpins cryptocurrency, blockchain, is designed to be decentralized and open source. This means there are no gatekeepers controlling who can and cannot participate. You don't need a broker or a bank account to get started. And the best part? You can invest as much or as little as you want. Whether it's a few cents or a few $1,000,000, the choice is entirely yours. In addition, cryptocurrencies operate around the clock. Unlike traditional stock markets, which have set trading hours, cryptocurrencies can be traded 24/7. This means you can manage your investments on your own schedule, providing a level of convenience that traditional assets can't match. In terms of accessibility, cryptocurrency clearly has an edge. It's democratizing the world of finance, making it possible for anyone to become an investor. However, with greater accessibility also comes greater responsibility. It's crucial to remember to do your due diligence and make informed decisions in this dynamic and rapidly changing market. Risk is a major factor when considering any investment. It's like a thrill ride. Some of us love the adrenaline rush, while others prefer a smooth, steady journey. Let's delve into the risks associated with both cryptocurrency and traditional assets. Firstly, cryptocurrencies. With the high volatility in the crypto market, there's a potential for huge gains, but also substantial losses. The value of a cryptocurrency can fluctuate dramatically in a short span of time, making it a high-risk investment. Additionally, the absence of a central authority means that if your digital wallet is hacked, or if you lose your access key, your cryptocurrency could be gone forever. Then there's the regulatory risk. The legal status of cryptocurrencies varies widely from one country to another and is still undefined or changing in many of them. This adds an additional layer of uncertainty to investing in cryptocurrencies. Not to mention, the market is still relatively new and technologies are rapidly evolving, meaning there's an inherent risk of the unknown. Now let's consider traditional assets. With stocks, bonds, and real estate, the risks are different but still present. Market risk, for example, is a significant factor. Economic downturns or company-specific bad news can cause the value of these assets to drop. Then there's liquidity risk. Some traditional assets like real estate can take a long time to sell. If you need to access your investment quickly, you might have to sell at a loss. Inflation is another risk. The value of your traditional assets might not keep up with rising prices, reducing your purchasing power over time. Lastly, there's the risk of fraud or mismanagement. While regulatory bodies are in place to mitigate this risk, it's not eliminated entirely. Unethical practices by companies or fund managers can erode the value of your investment. As you can see, both asset classes come with their own set of risks. It's all about understanding these risks and making informed decisions based on your risk tolerance level and investment goals. Remember, we are not financial advisors, so always do your own research before making any investment decisions. We have covered a lot of ground today. We've delved into the fascinating world of cryptocurrency and traditional assets, dissecting their intricacies, similarities, and differences. We've explored the volatile nature of cryptocurrency, contrasted with the relative stability of traditional assets. The accessibility of cryptocurrency, with its borderless, around-the-clock trading, was also juxtaposed against the more regulated and time-bound nature of traditional asset markets. In our dive into the risk factors, we underscored the potential for high returns with cryptocurrency, but also its susceptibility to dramatic price swings and market manipulation. On the flip side, we examined the lower risk, yet also lower potential returns of traditional assets, their vulnerability to inflation, and the impact of global economic trends. But let's not forget, all of this information is not financial advice. We've merely presented an overview of cryptocurrency and traditional assets, their volatility, accessibility, and risk factors. The decision to invest in either or both ultimately lies with you. It's crucial to do your own research, understand your risk tolerance, and perhaps seek advice from a financial advisor. Whether you choose to delve into the unpredictable but potentially rewarding world of cryptocurrency, or stick with the tried and true traditional assets, remember that every investment carries some level of risk. The key is to make informed decisions based on thorough research, careful consideration, financial goals, and risk tolerance. Before we close, let's remember that the world of finance is ever evolving. The advent of cryptocurrency has significantly altered the financial landscape, introducing a new asset class with its own unique risks and benefits. Similarly, traditional assets have been and will continue to be influenced by global economic factors and advancements in technology. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notification so you'll get updates anytime we upload a new video. Stay tuned as we continue to explore the ever-changing world of finance and investment. Until next time, keep learning, stay curious, and remember, knowledge is the best investment you can make.